Welcome to the iSoftpull main course podcast, where we get straight to the point, the meat and potatoes. Now let's dig in.
Welcome to the podcast, Season 1, Episode 6 of the iSoftpull main course. We're talking to Chris Linden, a founder of Sipadan Capital. He's also a corporate attorney was a corporate attorney in the restructuring group at Weil Gotshal, and then was a corporate attorney in the finance department at Latham Watkins. He's also the vice president and general counsel here at iSoftpull. And so today we're going to be talking about growing your company, whether to bring on debt, take out loans, or to maybe issue equity, whether that's stock options or raising equity and doing a Series A round, Series B round, getting seed money, the differences between giving equity and taking debt, what are the benefits? So let's dive right in. Welcome to the podcast, Chris.
Glad to be here, Dan. Thanks for inviting me.
Absolutely. So today we're talking about whether an entrepreneur or a business owner should take on debt or issue equity, right? What are your first thoughts about that, just generally speaking? What are your thoughts on it?
Well, as you mentioned in my biography, the intro, I am very much from the debt side of things. From that school, I was trained as a restructuring attorney at Weil Gotshal back when that was the thing to do. 08, 09, 10. There was a lot of companies restructuring at that point because they took on debt, right? And they couldn't service that debt. So I'll circle back on servicing of debt and things like that. But I then, when I moved out to LA and was working at Latham, I did what's called debt issuance, right? So instead of restructuring the debt once it gets in trouble, I was representing lenders, but primarily borrowers in structuring the debt that they were going to take on for their businesses. Now, most of those businesses in my primary practice were not startups. They weren't emerging growth companies, although I did a couple emerging growth deals, and those are different. That's a different type of capital, and we can talk about it, but it's called venture debt. And it's more akin to structured equity, which is sort of like mezzanine financing. It's got debt and equity features. But when you're a founder and you're sitting there and you're like, I need capital, right? That's the first question. Do you need capital? There's some businesses that are profitable from early on and they can fund their own growth to some extent, internally, we call it, right? And that's ideal. If you can do that, if you can fund your business with your own profits, and you can grow at a rate that's attractive to you and meets your goals of your growth goals, don't ever talk to a venture capital firm or an investor. Don't ever talk to them, okay?
Just do it yourself.
Do it yourself.
If you could.
Yes. I think we both know someone that I'm, married to, okay, who didn't have to go out and get investors, right? The
Sure.
business that she was in was profitable enough. Did she grow as fast as she could? Probably not. I mean, if she took on capital, she might have been able to grow faster. But every piece of equity, this is what I would say, which is against my interests as an investor. Every point of equity, if you truly believe in the company you founded, you need to hold on to, like it was your firstborn child, every 10th of an equity point, because that is where your value is. You don't understand this point until you exit an investment for the first time and you get the waterfall or you get the pro forma distribution waterfall from the lawyers or from the banker, and you start to look at the difference between the distribution that someone's getting who owns 8% and the distribution that someone's getting that owns 12%. And how big that number is. And as a founder, you want to hold on to every point of equity. So there's two ways to do that when you're first starting, right? you find a lot of companies that I see in my world of venture investing where they come too early, right? They're
To the
coming
venture
for
fund to you?
capital. What?
To the venture fund to you, they come too early?
Yes, they do. Okay. They come to investors too early, right? Because you, the thing that the thing that I didn't understand, and I'm not sure, I think there's a lot of smart people. I think there's a lot of wonderful, amazing, creative founders, and they're great at what they do, right? But what and they don't and it's not even so much that they couldn't be great at finance, right? It's just that they don't care. They're focused on what they're doing and getting better at what they do, right? And some of them are, the good ones are obsessive, right? The good founders are ones that are so myopic in their views that they are literally just trying to create the perfect rocket ship or the perfect, electric car. I'm just using Elon Musk as an example because he's everywhere these days, right? Those that's what makes them a great founder, right? But it's also what makes them not a bad not, not a bad finance person, but someone who's just not paying attention to it. And I think that what you need to be aware of when you're a founder and you're a business owner, right? Call them founders, but that's just what we call them in the VC world. You're a business owner, you need to do the calculus, right? You need to say, okay, if I take on X amount of capital, how much can I grow? And if I don't take on the capital, how much can I grow? And then most importantly, in both of those scenarios, not taking capital or taking capital, how fast can I get to where I want to go? Right.
And so why do they come early?
So the problem with so as an investor, I'm going to say, how much is your business worth? Okay. And if you come to me before you have any revenue and before you have a product even, okay, I hold all the cards. I'll just say you have an idea. And as you know, Dan, an idea is much less than a quarter, half of 1% of the game, right? Everyone has ideas. We all have ideas. It's coming to work every day when everyone's telling you that you're not going to succeed, okay? And pounding it out and getting the work done, putting boots on the ground, getting it done. You know that because you founded a company, right? Everyone has ideas. I always like to say that's a great idea you have, but how are you going to make me money? So if you come too early to the investors and you say, hey, I need money, I need $100,000. You see it on Shark Tank all the time. Okay. They come there and you're going to get eaten up and you're going to end up giving away far too much of your company. Okay. For far too little capital because your business isn't worth anything then. Right. So my advice to any founder out there, except for one that I'm interested in investing in, okay, is bootstrap it as much as you can.
As long as you can.
Find your own money, borrow money from family and friends, okay? Don't give up any equity until you absolutely have to.
So that's the founders, right? Or when you're starting in a company and you're talking about an idea, a lot of our clients and people listening to the show right now already have a business, right? They already have a team, they're probably growing, they do a couple $1,000,000 a year in revenue, and they want to get to the next stage, right? They want to grow. And they're going back and forth in their head, should I get debt? Should I give out equity? I want to get an engineer. Should I give the engineer points to bring him on board? And they're having these conversations in their head and they're just going back and forth. What would your recommendation to them be?
Do the math. It's a cost of capital situation. That's it. I could sit here all day and tell you about how debt has restrictions and covenants and all that kind of stuff in there. But when it comes to small business lending, okay, you don't really have to get in. I mean, yes, the bank is going to be able to contractually restrain you with a debt document, right? There's going to be covenants in there, but I would be less concerned about that as a small business owner, and even as a middle-sized business owner. Those banks, as long as you pay, you stay, is kind of been my experience, right? So the real difference, to boil it down, not to get into too many details, right? And this is across the board, right? So it's not talking to a specific company. There may be different, calculations. Debt is a fixed return, okay, to the investor, i.e., the lender, okay? So you can sit there and say, all right, this capital is going to cost me 10% plus prime. So 13% a year in interest. You know that's your cost of that capital. So it's a simple calculation. What is that? $13,000 of interest, okay, on a $100,000 loan. Am I going to be able to use that $100,000 to make $13,000 or more that year?
Yeah. So you would recommend, against your interest, get debt instead of issue?
The best case scenario, okay, for a business that has free cash flow or EBITDA, okay, or profit, if you want to, if they have cash that's generated after they pay all their expenses, okay, they are what's called, in my mind, financeable, right, by banks, by institutional banks, or even these alternative lenders out there, right? If you can do that, do it all day long. Just make sure that you're doing that math problem correctly, right? Now, you're not always going to be right, because there's a lot of assumptions associated with making that calculation. But the equity calculation, okay, is a harder one to do, right?
Much
Because
tougher.
valuing the equity is a lot harder than, a percentage of a number, right?
Sure.
There's a lot more that goes into it.
So do you think founders should consider not just the money that they're going to take in, but maybe what other benefits this investor might come in, right? Maybe they are strategically aligned, and should you consider that?
My answer about debt versus equity is different based on specific, examples that you give. I'm just saying, across the board, this applies generally. Debt versus equity, those are the considerations I would give, right? Equity is great if you're looking for a partner, right? And when I say looking for a partner, I find a lot of people are going out there being like, I'm going to partner up with this person. And it always sounds great when they're telling me that they're going to partner with this person. And I ask them a very simple question, and you'd be surprised how many times they can't give me an answer. In one sentence, tell me what this person or this entity brings to your venture. Okay?
What do they say?
There's usually not an answer. There's a vague answer, right? But what it normally boils down to is a situation where there's work that can be done in their business, okay, that can get them what they need relatively easy without having to give up percentages of their company or partnering with another person. You know this maybe not as good as I do, because I'm married to someone who is not a partner person, okay? Having a partner is hard. There's a lot that goes into having a partner, okay, that has nothing to do with the success of the operation of the business, right? There's a whole nother level of intricacy that's associated with a partnership, whether that's one partner, three partners, for whatever, okay? There's the business, and then above that, you have how this partnership is interacting. So I always, my default answer, if someone comes to me, whether it's a client or a portfolio company, and says, we want to partner with someone, my default answer is no. Don't do it. Don't do it. Convince me that you need to do it, and then we can talk about it.
So would a specific response be, we're considering taking on this partner, they're going to buy in for $5 million or $3 million, and they have this technology that makes ours better, right? Or there's got to be some and that where the equity you're issuing in exchange for the money is not the only consideration. Because that's what it would be for debt. If we're going to get $1 million in debt at 10%, it's going to cost us $100,000. If we're going to issue equity in exchange for for money, there's a specific number. But when this other group comes to you and says, well, we're going to give you money and we're going to bring this product or we're going to bring this client, there might become some kind of synergy, right? That might be better. Have you had any experience, or maybe you can give us an example that you've seen?
It's funny. We have an investment in they're in the sports marketing industry, which is blowing up right now because of this name, image, and likeness. Basically college players being able to get paid for their name.
John Daly just got a sponsorship from Hooters, his son.
Who did?
John Daly's son, NCAA Hooters.
Yeah, there you go. I mean, and frankly, just totally aside from this conversation, I think this should have happened a long time ago. I mean, these college players are playing effectively professional level sports, and their coaches are getting paid professional level salaries, and the colleges are making an insane amount of money off of them. So don't get me started, but they should have been getting paid a long time ago.
Yeah.
In that world, okay, in the marketing world in general, it makes a whole lot of sense to partner, okay, and access additional networks. So if you were to go to someone like Learfield or one of the big talent agencies, right, or one of the sports agent groups, and say, hey, we're going to partner with you. We'll give you a chunk of our company, and you refer all your clients to us, right? Then you're getting something. I actually love partnerships where there's no money involved, meaning there's no investment involved in cash, right? Those are normally the ones that are synergistic, right? Because when there's money exchanging in either direction, it usually means that one party is providing more of a non-cash consideration, like something that makes me money, like an idea or a business, okay, or a stream of revenue, that one party's trying to pay cash for that. And I don't need cash, right? I want something that's going to come to the equity of the business that I own, that's accretive to that equity, right? Like, for example, a CRM, partnering with a CRM in the mortgage space, right, where you get all the leads from the CRM. That makes sense to me, right? That makes a lot of sense to me. And in the people that are pulling in sort of your clientele, if you will, there's probably a lot of opportunity to partner with people. Okay. Again, though, most of your clientele, okay, most of your customers, I would imagine, are running businesses that are self-sustaining, right? They're not burning capital, right? Unless there's some pure software companies that are just in development, and they need credit checks, or they need to pull credit. I can't imagine that there's too many of your customers that aren't running a cash positive business.
Yeah.
Right?
Most of our clients are cash positive, and they're growing.
Yeah.
Right?
So if they want to, go ahead.
They come to us because they want to scale. They want to become more efficient, right? So most of our clients come to us and they've been doing this course of business that is not efficient. And so their mindset when they come to us, they're making this change. They want to become more efficient. And so at the same time, they've got this growth. And so that's why we're doing this podcast here, is because most of the listeners here, they want to grow, they want to get more efficient, they want to get better. So at the same time, they're thinking, do I take on debt? Do I issue equity to maybe a venture capital fund or private equity if they're a little bit larger? Or do they partner, that we're talking about right now?
Do debt, do as much debt as you can do. Okay. If that doesn't get you where you need to go, okay, if that doesn't allow you to raise, which normally it doesn't, right? Like if you really want to blow it out, you're going to have to issue some equity because most investors aren't interested. The risk that an early stage company or even a later stage company that's a small company still, okay, there's a heavier risk on that. One, it's illiquid. You can't just go trade it on the stock market. Investors are going to demand a higher return the more money that they're putting in. Okay. So you may be able to finance, let's say you go 3 times your free cash flow from a bank, right? 3 times EBITDA, you're able to get that amount of money on a secured line, term loan, 5 years, right? Interest only for the first 2, and you start paying it back after 3. Okay. It amortizes after 3 years. At some point, if you want to supercharge your growth, you're going to have to sell a chunk of the company and take in some equity because no one's going to give you the amount of money you need without getting some of the upside. Now,
because the bank's only going to give you 2 or 3 or 4 times.
4 times EBITDA. Yeah, I mean,
And you need more than that if you want a rocket ship, if you want to
if you want a
grow.
rocket ship, you're going to have to go higher. But see, this is where structured equity comes in, right? And mezz financing comes in, and it's getting more and more popular in my experience in the lower market, right? It used to be something that was only for massive billion-dollar deals, right? Large private equity firms were able to get banks and alternative lenders like BlackRock to issue this type of debt. Okay. Now it is a debt instrument. So it has a fixed return, okay, which is normally pretty high. Okay. And then it has either warrants, penny warrants that go with it, or some sort of equity component so that investor can participate in a fixed return as well as equity upside.
So they want both.
They get both. Yeah, they get both, but they're willing to extend you more money and they're willing to be subordinate to a term loan, right? So if you really want to get creative, you can take on what they're calling now, which is just weird. It's changes all the time. It's hybrid capital, right? So you're looking at a debt/equity security, okay? What this can allow you to do is, let's say your EBITDA is $100,000 a year. Okay, let's just use that number because it's easy. You could take 300,000, probably a bank would probably lend you 300,000, right? In what's called senior secured first priority term debt. Okay. With this sort of hybrid capital or mezz financing model, you can then go and say, okay, and you're probably paying interest rates are going up 5 to 8% for that senior debt. You can be like, well, I want to be a little more risky. I need more capital. So you can say, okay, you go to one of these mezzanine lenders, these funds, and you say, okay, I want another 500,000. Okay. So 5x your EBITDA, and I'll pay you, the rates are anywhere from 10 to 15. Okay. And I'll give you 3% warrant coverage, which is basically like 3% of the company on a fully diluted basis, right? Then you're able to leverage the assets of the current business and get 800,000 as opposed to 300,000.
So are you getting 2, or are you getting 2 loans in that case?
There's 2 facilities. The bank will sit in the first position, meaning they'll get paid back first in a liquidation, okay? And the mezzanine lender, that second lien debt, they call it, right? There's so many cool names for it. I could go through all of them, but basically first, second, okay? And you just stack the debt, you know? And back in 08, I mean, 07, the glory days, I mean, they'd go 7.5 times on that first lien debt, okay? And then they'd go 4 or 5 on top of that. But we all sort of witnessed how that ended up.
Yeah.
So there's ways to do it. And frankly, look, the problem when you're a small business, or even, let's say you're even doing $10 million of revenue. Let's say you're doing $20 million of revenue and you're pulling down $4 million of EBITDA a year. Okay. If you want to do the transaction that I just described in a very basic sense, it's going to cost you $250,000 in legal fees. You got to pay the bank's legal fees. You got to pay the mezz lender's legal fees. You got to pay your counsel's legal fees. I mean, it's not for the faint of heart. So you really, and it's expensive capital. I mean, you look at $500,000 at 10% interest, that's 50 G's a year, right? That's just coming right out. I mean, now obviously you're getting a deduction for that, but you're effectively accelerating your EBITDA. You're taking the money now that you're going to make over 3 years, you're getting it all at once, and you're paying it back over time.
Yeah. So in sum, if I'm hearing you correctly from this podcast, is bootstrap it as long as you can, right? If you got the money, or you can get the money, or you can borrow it from Susie or Joe, borrow the money.
Yep.
Right.
Yep.
Now, if you want to grow a little bit and you have some cash, and you have some revenue, so to speak, then you could probably go to a bank and get 3 times your EBITDA.
Sorry, if you have EBITDA.
If you have EBITDA, right, and you're profitable, right?
Profitable. Yep. Correct.
Then you can probably get 3 times your EBITDA.
You may be able to go a little higher than that, but I would say, I'd say that's a safe number.
So if you're doing 100,000, you can get 3 or 400,000. If you're doing $1 million, you can get 3 or 4 million. But there comes a time when a guy's a gal, CEO, company partners are gonna go, all right, we have a proven model. We have figured out how to sell this product. We just need to duplicate and scale. And in order to do that, I need more than 3x my EBITDA. I need 10x or 20x, right? They want to go from $1 million a year to $20 million a year, $20 million a year to $200 million a year. And it's at that point, if I'm hearing you right, when you might go to an investor and you're the guy for that, right?
I would love for you to come to me at that point. 100%.
So let's conclude this podcast and maybe I'll give yourself the platform, your fund, and the types of companies that you work with, and maybe some of our listeners might reach out to you, and how can they find you?
Well, so the website is sipadan.com, and it's SIPADAN, Sipadan. And our fund is, what we like to say is, we provide flexible capital solutions in partnership with founders and owners, right? Small business owners. We're not locked into a certain industry. We're not locked into a certain stage of company. Okay. We're what some would say opportunistic, right? We're looking for an investment that makes sense for us to make, but also for the founder or the owner to receive, right? I will not invest in a company if it's a great deal, I might do it. Okay, to be perfectly honest, but I don't think it's good business to invest in a company when I hear their pitch, and even if it's a good deal for me, potentially, I don't want to partner with someone who's then going to regret taking the capital on because they didn't need it. You know what I mean? I've been in those scenarios before, and it doesn't work for anyone. So I think if you're looking to supercharge your growth, and you're interested in taking on a partner, right? Someone who will be there to help you when they can, but won't get up in your business, because that's not what we do. We're trying to be partners. We know that the founders know their businesses better than we do. Okay. And we are trying to be helpful. We're not trying to impede your growth. In fact, we want to foster the growth, right? So reach out, more than happy to look at it. We look at we've seen a lot lately, a lot of direct lenders, smaller funds that are making direct loans to small businesses. That's a popular model these days. But yeah, no, I appreciate the time, and definitely reach out. Love to have a conversation.
Awesome. Well, thanks for joining us, guys, here at the iSoftpull Main Course Podcast, Season 1, Episode 6 with Chris Linden of Sipadan Capital and also Vice President and General Counsel here at iSoftpull. Tune in, subscribe, hit the link, hit the button, follow us. You know what to do. I'm not sure where you're listening into, but more episodes to come, and I look forward to chatting with you in the future. Cheers.
Thanks for listening. Subscribe to the main course for straight to the point business insights.